Hey guys, welcome to the channel. I'm Sheen, your host. This is Money Matters. In this channel, we talk about money, finance, how to make money work hard for you, how to grow your money, and how to invest your money. Check out my other videos. I do tons of videos about just what I said, also about credit cards and credit card bonus points, bank bonus points. So if you like what I'm doing, please consider subscribing. Give a thumbs up. It really helps out the channel. Today, we're going to talk about 10 mistakes beginners make in the stock market. So let's get started. All right. Number one, buying risky stocks. When you're a beginner, don't buy any risky stocks. What do I mean about risky stocks? Basically, stocks that you probably never heard of, or they're small companies, companies that are probably fly by night, companies that are not basically brand names. You really want to stay with brand names in the beginning when you start, because those companies are typically stronger companies in general. They have more money in general. They're able to survive a downturn, an economic downturn. So stick with the brand name companies. For instance, Google, Microsoft, Apple, 3M, these big companies that have been around for a long time, Johnson and Johnson, JP Morgan Chase, Wells Fargo. These companies are going to stick around. They usually have a lot of money in the bank, and they're not going to go out of business anytime soon. So the worst thing you want to do is put your money in something that is unknown and it just goes bankrupt and you lose all your money. So number one, don't invest in risky stocks. Stick with the brand names in the very beginning. So number two mistake beginners make is buying a company that you don't understand. So what I mean by that is, if you're going to buy a company, you're not just buying, when you buy a stock, you're not just buying a ticker symbol, you're not just buying a little dot on your computer, you're actually buying a fraction of a company. And if you're going to invest in a company, you should understand what this company is about. The company should align with your beliefs usually. So things like how the company makes money, how the company generates revenue, what is their net revenue, how much money they have on their balance sheet, how do they attain new customers, what kind of products do they make or services that they provide. You got to really understand that so you could kind of follow the company. If they are doing something that you don't agree with or doesn't make sense to you, you'll be able to spot that if you research the company. So you have to buy companies that you understand and you could grasp and you could see the potential and the growth. So if you see a growth potential and that growth potential is not factored into the current price, then that is potential that is the growth that the company is going to see, and that is the growth of your money that you're going to see. So if you don't see that potential and if you don't understand the company, it's probably not a good idea to get involved with that company. So number three mistake that beginners make is buying when the market is hot. And that's super common. You see Joe Schmo down the street making so much money that he's in the stock market. You see on TV, everyone's making so much money and you just want to get in. But typically when those things make headlines, it's because the stock market is hot. It's because the stocks have been going up, the prices are all-time highs, and it's really interesting that it gets reported on because that's what's interesting. Either when it's really, really high or when it's really, really low, that's when all the news comes out about them. Oh my gosh, do you see how high this stock went? Oh my gosh, do you see how low this stock dropped? But when it's just going up and down, that's kind of boring, so nobody talks about that. So when the stock is hot, when the market is hot, that's when a lot of beginners get into the market because they look at it and they think, oh, well, my neighbor down the street, he just put in, $500 in this company and now today it went up to $700. So everyone wants to get in at that time. But that is the worst time to get in. When the market is hot, that is a time when you need to kind of evaluate the situation, research the companies, and really find good companies. When the market is hot, usually those prices are overvalued. They're way too expensive for what you're really paying for. So that is mistake number three that beginners make. Mistake number four is just the exact opposite, is selling when the market is low. So when the market is low, it's not the time you want to sell. It's kind of like the opposite. When the market is hot, that's when you want to have some reserves, be more reserved, have some money saved up on the side, and just wait for opportunities. Research into companies, but not just throw all your money in. And the opposite is true. When the market is low, that is the time you want to throw all your money in. That is the time when everything is on sale. That's when stocks are on sale, prices are undervalued for what the company is. For instance, if a company was trading at, let's say, $300, so then it all of a sudden dropped to $200. That might not necessarily be because the company did something wrong, the company was not performing well. That just could be because of fear in the market, economic downturn like we have currently. So that has nothing to do with the fundamentals of the company. The company is still strong. The company is still doing revenues, doing good revenues, making good profit. So the stock price really has nothing to do with the underlying fundamentals of the company. So as long as the fundamentals of the company is strong, The stock price dropping just means that the stock is on sale. It was down, it was up to 300, and now it's at 200. So of course, it's the best time to buy. You want to buy things when they are on sale, when they are reduced prices. So if you're in the beginning of the market, you want to buy when the stock prices are dropping, not when the stock prices are going up. So mistake number 5 is buying too fast. What do I mean by that? I'm guilty of this. When I started, I was just looking at prices, and if they just dropped, maybe 10%, I would say, oh man, it dropped 10%, and I will put in so much of my money into that stock. And then what happens is I basically run out of money in order to try to reduce that price, because if the stock keeps on dropping lower, then I need to put more money in to get a lower cost basis. But if you put all your money up front, then basically you just use all your money and you're not able to buy additional at a lower price point. So if you're doing what you're supposed to, is buying when the stocks are dropping, it can always keep on dropping. Nobody knows what the bottom is, but you just know that the stocks are dropping, day by day or week by week. The price is going lower and lower. So you should be buying at every drop, or at least average your buys out in whatever time span it's dropping. So it could be dropping for 1 week, maybe 1 month. It could be dropping for 6 months. You would just be trying to buy in stages. Every time it drops, you pick up some shares, and that's called dollar cost averaging your way down. So you never want to put all your money up front on the first drop, because if it drops, 10% or 20%, and you threw all your money away, and it drops another 10% after that, then you're missing out on additional sale prices. So you don't want to throw all your money in. You just want to throw money in a little bit in the beginning. When it drops, buy a little bit more. When it drops, buy a little bit more. If it stops dropping, then you stop buying. If it goes up, then you just ride the wave up. But if it does keep on dropping, that's when you want to keep on dollar cost averaging. So that's mistake number 5. Beginners tend to buy too fast. Mistake number 6 is just the opposite, selling too fast. So for instance, if a price of a stock went from 100 to, let's say, 200, then a beginner might say, oh, I made a lot of money. I'm going to sell at my 200 and just sell everything. And then you made that extra $100 on each stock that you had. But that's not the good way to do it, because you don't know how high it's going to go. I mean, if you're done with the position, if you think the company no longer meets your criteria, or has done something that you don't agree with, or you can see projected numbers decreasing, or for whatever reason you think that the company is not going to perform anymore, I mean, it's understandable to be a good time to sell it, but there's no reason to sell it all at once, unless you were 100% sure some tragic news was going to happen, or something tragic already happened, and the stock is just going to crash relatively quickly. Then yeah, you want to sell it at the highest price point and just get rid of the position. But if things are still relatively stable, and you just want to get out of it, and the stock is relatively stable, it might go up a little bit more. It might go from 200 to 230 to 240. It might go up a little bit. So you should sell little at a time, just like buying little at a time. You kind of want to dollar cost your average way out of the position as well. And it doesn't always work out, but there's room in there. You bought it at 100. If it goes to 200 and it goes down to back to 180, you could sell it a little bit at 180. You took a little bit of loss, but you also had the opportunity of selling it if it goes up a little higher to maybe 220, So you don't want to just rush out of a position. There's always a chance that it could go up a little bit, and you'll be missing out on those gains if you just sell it all at once. Okay, number 7. Mistake number 7 is not looking into the financials of a company. So a lot of times, companies are in the news. People talk about the company. This person down the street bought this company, and they're interested in the company, but you don't know anything about the company. You need to look at the financials of the company. You need to know how much money they're making. You need to know the history, what they made last year, what they made the year before, and what they're projected to make in this coming year, and what they're projected to make maybe in 2 to 3 years. And what is their future projections? What are they doing that's going to bring in more revenue in the future? So sometimes those prices are not calculated. So if you could find something that's undervalued, that future prices aren't priced in yet, and you could look at their financials and you could see the growth of the company, and for whatever reason the stock price is not factoring this in, that's a really good company to get into. So you really got to look at the financials of the company. You got to look at how much money the company has. Does it have a lot of debt? Does it have a lot of cash on hand? So, a company that has a lot of debt could get into a lot of trouble in bad financial times, like the stock market crashing now. We're basically in a bear market. We're probably in a recession right now. So companies like this tend to go out of business if they don't have a lot of money to hold them over. Okay, mistake number 8, not reinvesting dividends and capital gains. So when you invest in a company, some of them pay a dividend. So you'll be getting a check every usually is every quarter. So that money that comes in, you should be reinvesting that dividend either back into the same stock or into a different stock. Definitely shouldn't be taking that money and going out and spending it. I mean, that's not, I mean, it's a paycheck really, but that money is your investment money. So you want to invest that money. You want to reinvest that money because essentially that's money that was made from money that you put in. That's how you get compounding on your money. So the money that you put in generated money for you, and then that money you put back in to generate more money for you, and that money you put back in and it generates more money, and you can see that nest egg grow, grow, grow if you keep on reinvesting your dividends and your capital gains. If you have a stock and you sold it for a good profit, that profit you should be putting it back into something and have your nest egg grow bigger and bigger. You need to reinvest your capital gains and reinvest your dividends. That's how you're going to get compounding growth. All right, mistake number 9, getting too emotional. The stock market is going to go up and down. It's super volatile. Depends on the stocks you have also. Some could go crazy high and then crazy low, and sometimes there's no rhyme or reason for it. The company could be doing everything right, producing good numbers, producing good revenues, but for whatever reason, the stock just keeps on dropping. And then you get emotional, and then you get scared, and then you sell it off. And then the next thing you know, after you sell it, it goes back up. So you never want to get too emotional. You just got to remember, if you believe in the company, you looked at their financials, you know where they're headed, you know they have a good balance sheet. Whatever happens in the short term, don't get too emotional. Don't sell on a panic. If a price on something goes really, really high, don't buy it at that price point because you're scared that you're going to miss out on future growth. So just stick with the logical numbers. Just stick with what you know about the company, and don't get too emotional with the company. There's a saying, I'm going to paraphrase it. It goes something like, the stock market in the short term is like a voting machine. People are voting on how much this stock should be. Some people will say it should be this much. Some people say it should be this much. So there's highs and there's lows. And then people vote on it. And then for the short period, this stock is going to fluctuate because people are saying it's worth this much when some people are saying it's worth this much. So there's highs and lows. And that's when it fluctuates. So in the short term, stock market is like a voting machine. People are trying to get the number right of how much this company is worth, and people don't know what it is. But in the long term, when the company is performing, you see the operations, you see their production, you see the numbers that they produce, then people are starting to come together, and that price kind of meets in the middle. The people that say it's too high lower their expectations, and the people that say it's too low raise their expectations, and then it comes to a pretty stable price, and then the fluctuations will be much less. In the long term, all companies do that. It'll be a much less fluctuation because everybody kind of comes to an agreement about what this company is worth. So in the long term, the stock market is more like a precision scale. It will weigh what this company is worth in the long run. So you want to get in when there's fluctuation, when people don't know what the price is of a company, and you could nab that company at a lower price because you researched the company, you know how much money the company has, you know what the company is doing, you know what the future projections are, you know future products or future services that the company is doing. So you know that this company is poised for growth. But for some reason, a lot of people are saying the company is way down here. So that's when you want to get in, and then you just wait it out until in the future, in the long run, the stock market is going to weigh this company and come to the correct price. And that's where you get your gains. Number 10 mistake that beginners do is not focusing on the long term. Just like I said, the stock market is really a long-term game. There are people that are in and out of stocks. They're basically day trading their stocks, and they could do really well. But it's been proven that the stock market is really a long-term play. You want to get on a company when it's priced undervalued and just wait for that price to go up. If you're getting a good company, eventually it's always going to go up. So don't sell out short. Wait for the long game. That's where all the money is made. And that's number 10. Focus on the long term. Again, the short term prices are going to fluctuate. Don't get too emotional when prices all of a sudden drop after you bought it. That's just short term. In the long term, if the company is well, if the company is strong, you did your research, the company is always going to go up if it's a strong company. So that's mistake number 10. And that's my last one. So if you like what I'm doing, please consider subscribing. Check out my other videos. Give a thumbs up. It really helps out the channel. If you found any value of this video, please do give that thumbs up, and I'll catch you in the next one. Peace.